My name is Richard Jones. I'm an associate professor in the Accounting and Finance Department at Middlesex University, and my main role there is to teach taxation to the third-year students. Yes, certainly, because it's vital. When you make that decision, you're going to start up in business. What sort of process, what vehicle you're going to choose. Now, as a sole trader, the important thing to recognize is that whatever you do is just an extension of yourself. It is not a separate legal entity. So whatever profits that you made are added to any other income that you have. So let's say if let's say you were sort of partly an employee and you had a salary, or maybe you had some rental income. Well, they're all added together, and they're called non-savings income. So there is no distinction between your sole trader activity and any other activity that you carry on, and the whole lot will be subject to income tax. And the tax will be charged on the income after you've subtracted your personal allowance, which everyone is entitled to, 12,570 this year and probably next year as well. And then the rates of income tax will be applied. So you have 20% as the basic rate, up to 37,700, and then the 40% higher rates kick in, and then right up to 150,000 when you'll start paying tax at 45%. But then, one should feel really lucky to end up with making that amount of money. So we're talking about roughly, the move from the 20% to the 40% is the big move. And that happens at about just over 50,000, because by the time you've subtracted your personal allowance, you're then down to 37,700, which is the limit of the basic rate. Now, on top of that, you have to pay national insurance. And as a sole trader, you pay two types of national insurance. One is called Class 2, and the other one is called Class 4. Now, the Class 2 is a sort of, it's a weekly amount. It's actually quite a modest amount. It's just over £3. I think it's about £3.15. And that is collected with the normal tax charge. It's collected with the Class 4. And you don't have to pay that if your profits are under a certain limit, which is about sort of 11,000. But be careful with the Class 2, because what the Class 2 contribution does, it protects certain benefits, particularly the credit that you get for your, for your pension. So it can be advisable that even though technically you may not be liable to pay it because your profits are too low, and you would volunteer to pay it in order to protect those benefits. Now, the other one, the Class 4, now that kicks in. Now, it kicks in as a strange sort of limit. If I can sort of check what it is this year, it's actually 11,908, which is sort of a slightly strange one. But as we all know, the government has been playing around with national insurance all through this year. So what we have this Class 4, and even the rate is strange, so I have to consult the numbers. It's 9.73% of the profits over £11,908, and that is collected also through the self-assessment system with the tax. So that is the essence of a sort of a sole trader subject to income tax. Now, comparing that with operating through a company. Now, the crucial difference with the company is got nothing to do with tax to begin with. I mean, if you form a limited company, the main thing you're achieving by doing that is limited liability, because as a sole trader, whatever you're doing is on the line if things go wrong. So if someone sues you for negligence, or as a sole trader, your personal assets can be exposed, to your creditors. The big advantage of having a limited liability is that, the exposure is limited to the assets within the company. So your own house, your own flat, and any other assets that you have are protected. So the main reason for forming a limited liability company, nothing to do with tax. It's simply, your own survival, and your own peace of mind, that you are protected. Now, the downside of that is that you have to share a lot of information with the public. Now, as a sole trader, it's all secret. Nobody knows how much money you make as a sole trader. There are no formalities as a sole trader other than telling HMRC. But as a limited company, you have to register with Companies House, you have to submit accounts to Companies House, and anyone can check, anyone can look at your latest balance sheet, anyone can see how much money is in the company. And very often with my students, I ask them on their way to a seminar to make a note of any company they noticed, a builder's van with a limited after the name. And then when we get to the seminar, I ask them to do a search and it's remarkable how much information you can then discover about that company, what their assets are, who the directors are, sometimes even where they live, certainly where the registered office is. So that is the downside of having the limited company. Now, as far as tax is concerned, it's slightly strange, but limited companies pay tax at just a single rate. It doesn't matter. It doesn't matter whether you're the smallest company or the largest company in the world. The rate is 19% of the profits. Yeah. Now, next year, there's a plan to increase that, but it's not entirely clear how that's going to pan out with the change of Prime Minister and change of Chancellor. And it may well go up to 25% next year, but currently it's that 19% for all profits. It doesn't matter what size of company, whether you're making millions or just a few hundred, it's 19%. So if we now do the comparison, you might think, well, okay, if you're a sole trader, as soon as you hit 50,000, you're into 40%. If you form a company, you're going to stick at 19%, no matter how big you are, at least this year. So you can sort of come to a conclusion that, well, surely from a tax point of view, you should always be in a company, because surely 19%, well, it's better even than 20%, and certainly better than 40%. But there's a snag, because as a sole trader, once you've paid your income tax at 20 or 40, or paid your Class 4 national insurance, the money is yours. There's nothing more to pay. In a company, you've paid your 19% in the company, but the money's in the company. So the question is, well, how do you get your hands on that company? You can't treat the company as your own because it isn't. The company is a separate legal entity. Now, there are various ways of getting the money out of the company, but they all involve an additional tax liability. Now, the obvious way, I suppose, is to pay yourself a salary. You're probably a director of the company, so you can pay yourself a salary. But as soon as you start paying yourself a salary, income tax will kick in. And of course, if the salary is over 12,570, which is the personal allowance, then you're straight away into the 20% and potentially 40% bracket. And even worse than that, you're then into what's called Class 1 national insurance, where the employee and the employer is then paying national insurance. So that's not a terribly good idea, usually, to pay yourself a salary. So what are the options? Well, you could pay yourself a dividend. And the benefit of a dividend is that there are much lower rates of tax. Now, again, these are rather weird sort of rates, and I'm just going to check what the rates are this year. Now, the rate of tax, if you are a basic rate taxpayer, is 8.75%, which of course is better than the 20%. And in fact, the first 2,000 of dividends is actually tax-free completely. If you're paying yourself a lot of dividends so that you're into higher rates, then the rate is 33.75%. Now, the point is, you have to pay something. You have to pay something extra over the 19%. So the decision as to whether to be a sole trader and a company from a tax point of view isn't as straightforward as saying, let's go for the 19%. It all depends on how you're going to extract the money from the company. And of course, an accountant would advise typically on a combination of maybe a modest salary, maybe up to 12,570. And then followed by dividends. Dividends aren't subject to national insurance, so that is the advantage of paying the remainder in the form of dividends. But it's an exercise that you have to undertake in relation to sort of each scenario, and it depends on the level of profits. Are you going to make 10,000? Are you going to make 50,000? Or are you going to make 100,000? So that is, in essence, the distinction between the sole trader and the limited company. Yes, I mean, sometimes when people talk about the cash basis, they usually think it means you don't have to report cash receipts to HMRC, but of course that is not the real meaning of cash accounting. Cash accounting is you certainly have to report all the income that you receive. But the big difference is it is a much simplified system, so that instead of having to recognize accounts receivable and prepayments and accrued liabilities and inventory, and instead of having to sort of distinguish between things that go through the profit and loss and the balance sheet, that's all the traditional accounting. You have a very simple system which is called cash in and cash out, so that you pay tax on just the difference. So the profit at the end of the day is simply the difference between the cash that you received and the cash that you paid out. So, for example, when you send out an invoice in traditional accounting, you have to record that invoice straight away. When you're sending it out, and you could potentially even pay tax on that, even though you've not received the money from your customer. With cash accounting, it's much more straightforward. You wait till the money's come in, assuming that it does come in eventually, and then you record it as cash in, and that is that is your turnover. The drawback in that sense is that you have to be the same with expenses. You have to actually pay your suppliers before you can record the cash expense. You can't record it as soon as you receive an invoice from your supplier. But that's fair enough, isn't it? I mean, you can't have your cake and eat it. You can't, if you're doing cash accounting, you have to do both sides on a cash accounting basis. Now, in a way, it sounds too good to be true, in the sense of that you can do everything on cash. And I think HMRC, when they drew up this scheme, sort of panicked a little bit, because they could imagine that if you can subtract everything that you paid out, you could go out and buy a car, for example, and subtract that, in arriving at your profit, 20,000, and you'd never pay tax, and of course they backed off. So there are limitations, and the most important in practice is that you can subtract the cost of equipment, you can subtract the cost of buying a computer, you can subtract the cost of buying a van even, but not a car. A car is a no-no. You can't subtract the entire expense of buying a car for your business. You can claim sort of mileage allowances and things like that, but not the whole lot. The other thing you can't subtract if you're borrowing money and you're paying interest, which of course many businesses would do. You can't subtract the interest expense beyond 500. You're allowed 500. And that's okay. But beyond that, you're not allowed. So you can see what I'm driving at, that the cash accounting system of paying tax is very useful, cuts out a lot of the detailed record keeping. You still got to keep accounts, obviously, of cash in and cash out, but it cuts out an awful lot of the other traditional accounting. But there are limitations. You would not use it, for example, if you had a very big overdraft, and so that where your interest expense is more than 500. But otherwise, it's certainly worth considering. Yes. I mean, I always say to in these sessions, one should always start one's question with, a friend of mine. You know, and if you can think of a situation where a friend of yours has a tax question, by all means, you know, you can add it as a supplementary. By saying a friend of mine, of course, what you really mean is me, isn't it? And a number of our delegates, they although it was to do with entrepreneurial finance, I mean, of course, they took the opportunity of raising personal tax issues. And the really interesting one is something called the marriage allowance. And it is one of the allowances that is least understood and least claimed by people. And what it involves is everyone gets 12,570 personal allowance, but you can transfer, as a married couple, you can transfer 10% of it, which is 1,260, to your spouse. And okay, it's not a huge amount, you know, and if you're a basic rate taxpayer, and you can only do this if you are a 20% taxpayer, they don't let 40% taxpayers do this, which is fair enough, isn't it? Certainly not 45% taxpayers. If you take 10% of 12,570, let's round it up. Let's 10% of that comes to 1,260. 20% of 1,260 is about £250. That is the potential reduction in your tax bill and the potential refund from HMRC. And because you're allowed to go back 4 years, there are many cases that I've come across this where people realize, ooh, they could have claimed this for the last 4 years. So the headline grabbing possibility is get £1,000 refund, this is something that we were discussing. And the way it works is, I mean, take the classic scenario. Let's say you've got husband and wife, and one of them is at home looking after the children. It doesn't work. The other person works full time, but it's nowhere near the 40% mark. Well, they're entitled to this. Yeah? So anyone in that position. So it works where one of the spouses is under the 12,570. Because obviously, if both spouses are using their 12,000, there's no point. You know, I mean, you can do it, I suppose, but there's no point, because if you're both using your allowance, there is no tax saving. But where one of them is under the 12,570, or in fact earns nothing at all because they're at home, well, there's the £250 refund straight away. And by going back for 4 years, there's £1,000, and that's quite nice to have, you know, in today's straitened times. You know, just that opportunity. That was one of the things we discussed. There was one other, which actually is at the other end. It's a bit of bad news. And they were talking about child benefit. Now, child benefit is tax-free. You know, if you're claiming child benefit, there's no doubt about it. It is tax-free, but there's a big but. And the rules say that once you start to earn over 50,000, you have to pay it back. And you have to pay it back through the tax system. An awful lot of people are not aware of this. So an awful lot of people, it's called the high income child benefit charge. Well, a lot of people would not regard 50,000 as particularly high income. So people in that sort of bracket, they're not typically in the HMRC self-assessment system, you know, so they don't normally file tax returns. And it comes as a huge shock when they discover that they should have been within the system, that they should have repaid some of this child benefit. And just to give you a little bit of a feel in terms of the numbers involved, let's say you've got 2 children. This year, your child benefit is probably approaching about 2,000 on those two children. At 50,000, you have to start paying it back, and by the time you get to 60,000, you've got to pay it all back. So there's a sort of graduated scale. So, for example, let's say you're on 55,000. You've got to pay back 1,000 of that child benefit. So that really catches out people, and the message is, you know, tell HMRC, you know, that you are in this position. But the one thing you shouldn't do, what some people think, well, I won't claim the child benefit then if I'm going to have to pay it all back. But that could be a disaster, because the child benefit again contributes towards pension entitlement. Registering for child benefit is a vital part of it. You know, so one should always register for it. You can then say, look, I don't want it, thank you very much, but don't sort of don't ignore it completely, and be aware if you're in that tax bracket between 50,000 and 60,000, that you should be telling HMRC about it. Yes, that is really important for a new venture, and because this is dependent on setting up a company. So going back to where we started, there is no choice now. I mean, this relief is available when you set up a company. It's not available for sole traders. You're setting up a company, and you've got friends and family, and typically when someone is starting up a new venture, they raise money from friends and family. So if it can be done in a way that reduces their tax liability, then obviously one should go for it. And the way that it works is basically it's a 30% tax relief. So it doesn't matter whether you are a 20% payer or a 40% or 45%. The relief is given at 30%. Let's say I'm going to set up a company today. It's a new business venture, and I think you've got a little bit of money stashed away somewhere that is not, or at least in the past, hasn't been earning very much interest. I mean, you're probably getting a bit more these days on your interest. So I would say to you, look, could you invest £10,000 in my company? And what would happen then is I would issue you with shares, or at least my new company would issue you with new shares, £10,000. But you would get £3,000 back from HMRC. That's the 30%. So in terms of what you've invested in my company, it's actually only cost you £7,000. Yes, provided of course you have paid that. But you're probably a full-time employee, so you probably under pay as you earn. You will definitely have paid that £3,000 at some point during the year. What it means is that if things don't go so well, your investment may fall in value, but it can fall in value to £7,000. And you still haven't lost any money. That's the point. It's an incentive for you to take that risk by investing in my company. And if it's a new venture, the company's only been trading for a couple of years, if it's really new, HMRC will give you 50%. Now, the one that I started off talking about is called the Enterprise Investment Scheme. And the one where you can get 50% back is called the Seed Enterprise Investment Scheme. Now, if you can get 50% back from HMRC, then your investment, obviously you're not at risk of losing your money until you've lost sort of half of it. So you can sort of get a sense that this is really aimed at encouraging people, to compensate them, because obviously it is a risk. My company's only just started trading. Maybe if you're going for the 50% one, and it's not a quoted company, so there's no way that you can. There's no market for the shares. And you've got to hold them for a few years to get all these reliefs. But it's something that would obviously you're going to be more likely to invest in my company if you get that refund from HMRC. There are all sorts of rules which I won't go into. There are rules about what type of business can qualify. I mean, HMRC doesn't like property development companies, doesn't like hotels, doesn't like businesses where there's a sort of an asset, which, in other words, they try and eliminate those companies where there's really not so much risk. So there's a list of about 10, 15 trades that you're not allowed to have. But in a regular sort of business, and particularly if the trade has just been set up in the last sort of couple of years, that 50%, the Seed Enterprise Investment Scheme, it can be absolutely a lifesaver for people setting up a business. There's one last condition I should tell you about. You can't own more than 30% of my company. So I need a few. I need a few more people, to put in some money as well, because you can't be more than a 30% shareholder, and you and I we can't be associated. I mean, there are certain rules as to who is associated, but you and I are definitely not associated. We know that, and therefore there's no problem from your position in that sense. But any entrepreneur thinking of raising money should think about this. For the 50%, it's got to be in the last, sort of set up in the last couple of years. For the 30%, it can be an established business where where they think of expanding. So there is the difference, and there are monetary limits for the 50% one, which are much. I think the most you can invest is 100,000, for example, in the 50%, the seed one. Whereas I think the limit at the moment is about $1 million for the other one. So if you can find an angel investor, who's got a few 100,000 to invest, that is a definite possibility. But think about those two schemes if you are seeking finance.